All right, so today's lesson we're going to be talking about the master pattern. This is level 1 understanding of the master pattern concept, and we're just going to be doing basically an overview of what is the master pattern and the different phases and everything that it entails on just kind of a surface level. So this group in here, I'm expecting this is going to be pretty elementary things for you guys, but always good to revisit concepts, even if you know them well, just to kind of brush up. I find that going through this information, every time I revisit it and go through it, I learn other little nuances and other little things. Just kind of, just the refresher in general really seems to help me. So that's why I like teaching it, because it's like every time I teach it, I get resold on how effective it is. There's no other explanation out there that has a solid foundational way of explaining every little thing that happens in the market. The fact that we could classify every single candle as being in one of 3 market conditions or 3 market phases is pretty incredible. And when we can classify each and every candle inside those conditions, then we know how to treat that candle and how to generally forecast how the market's going to behave based on it being in that, or that candle being associated with that phase. So I find that it's super powerful that way. So anyway, let's go ahead and get started. So master pattern overview. What is the master pattern? The master pattern is a trading methodology developed by TradeATS based on the laws of supply and demand, pain and pleasure theory, and mixed with institutional accumulation and distribution theory. So it's kind of a mishmash of a bunch of different concepts that that I have come up with personally, but it's also a mishmash of things that I did not come up with. That being 3 market phases. I always tell people I did not invent that. The first time I heard of that was by a fellow named Martin Cole. You can still look him up on YouTube. He does things every once in a while, not super active, but at this point. But he didn't invent it either. But he's the first person that put it in a framework where I thought, okay, that makes a lot of sense. And it got me thinking along the lines of, it's not just general candle patterns and only support and resistance and just the head and shoulders and all these other things that everyone else is looking at. He's the first person that got me to think, okay, it's these general phases that the market goes through that lead to different behaviors in the market and different outcomes. And you can use those phases to forecast what you think is likely to happen. So that's where I found that, and I continued to dive deeper. I've come up with my own lingo and terminology around it that made more sense to me, like expansion, contraction, things like that. Those terms were more representative of what it was to me personally, but I didn't invent it. So neither did he, and probably the person he learned it from didn't invent it either. It's been pretty much around for a long time, but not a whole lot of people teach it or understand it. So thankfully, we've had these people come before us that have continued to bring these concepts to our attention. And I think through every person that studies these deep, it gets another level of refinement. And that's the service I'm hoping to give to these concepts through what I've determined as my interpretation is the master pattern. I'm just trying to serve the overall methodology and help refine it down in a way that people can understand in a way that's helped me. So it's also mixed with pain and pleasure theory. That's something I did invent. That pain and pleasure theory is the difference between how people say the markets are driven by fear and greed. I don't think that that's necessarily the case. I think that there's definitely fear and greed that play a part in it. More fear, I think, than greed. In fact, I'll say that the longer people trade, the less greedy they become. And I know that we've all been through this situation probably at one point or another. When you first start trading, you're just like, oh, I could get rich overnight. I could, become a millionaire super easy. And the way that especially social media makes you feel like I could just jump in and make tons of money with this thing. You quickly find out that's not the case. It's going to take a lot of hard work, a lot of study, a lot of discipline, right? And then over time, as you realize how hard it actually is, you get less and less greedy. You're like, if I could get 30 pips a day, I'd be happy. Then you realize that's pretty hard if you're day trading to consistently get 30 pips. Then you're like, okay, if I could just get 20 pips a day, I'd be happy. That's still pretty hard, especially if you don't have if you're just going off like mass taught patterns, things like that, traditional indicators. Then you go like, if I could just get 10 pips a day, and that goes all the way. You're like, if I could just be positive every single day, I'd be happy. If I could just get 5 pips, you end up, because it compounds. The whole point is just being positive on a consistent basis. And you start to understand it. So I think when people say fear and greed controls the market, I think that it's more fear controls the market more than greed over time. So just my interpretation. But my spin on this was pain and pleasure, is that fear and the pain that comes with fear when things start to happen to you is what creates automatic behaviors in the form of transactions in the market. Moving your stop up tight, getting out of the market. People are much more likely to close a trade when they are losing versus winning, because we're going to cover this in a lesson in the future, but the gist of it is that people want pleasure to last, and profits equal pleasure. So when they're in the money, they become very lackadaisical. They don't do anything. They think it's going to keep going up and up and up, and then when the correction happens, it cleans out all their profit and then some, typically. So people are very much less likely to close when something feels good, like a profit, versus pain. The other side of that, the moment we feel pain, the minute we get out of the money, we're uncomfortable, you want it to stop. So it's just an inborn human response. No one needs to teach you this. You literally come out of the womb and you understand pain bad, pleasure good. And our entire life is essentially trying to figure out how to get more feel good and avoid pain in all aspects of life. So, and this is it's very raw in the market. So the idea with the master pattern is that, as we'll go through this lesson a little bit here and more in depth, and then the rest of these lessons, is that pain is the pain response in the market, particularly at stop loss levels, is where we'll define liquidity zones and things like that. That is really what builds this pattern at the end of the day, is the pain points. We have the neutral zone, but as it expands, the market leaves and goes in those 3 phases. The pain is really what constructs the pattern. So studying pain in the market and what that means is really, that's really kind of where it's at. And that's where this has led me personally. Going on to accumulation distribution theory. This is like Richard Wyckoff stuff way back, early 1900s stuff. Early stock traders, they understood that the big players in the market, they accumulate inventory and then they distribute it into a rising and falling market. Typically, we talk about, just to keep it simple, as the market goes up, they buy inventory before that happens, the price goes up, and then they sell that inventory into a rising market. And that's essentially how they view the business. Now, that also plays into supply and demand. You need people who are willing to buy something if you want to sell them your product, right? So how do you accumulate before something happens? Well, typically, this is where insider trading comes in. This is where market makers have the ability to suppress supply and demand. They're able to manipulate supply and demand, I should say, in their favor. So even if there is a lot of buying activity in the market, where the market would go, they can keep that suppressed because they control the floodgates of supply. So with that level of control, it allows them to manipulate the markets. But at the end of the day, what they're looking to do is everyone's looking to accumulate and then distribute for profit. You're going to bring all of your inventory in the form of your positions that you're buying or shorting, but we'll keep it easy. Let's just say you're buying, buy. That comes into your storehouse. You're looking to distribute that as the market eventually breaks out and goes up with the pending demand that's coming into the market. Everyone's trying to do that same thing. So the master pattern is our interpretation and implementation of time-tested principles and observations. So why is the master pattern important? It's the only methodology that gives a solid, objectionable basis to every single price movement in every liquid market. It's an unchanging framework that serves as a baseline to create profitable, consistent trading strategies. I think that that's the biggest thing that the master pattern gives us, is that underlying framework, the static levels. that it provides, particularly fair market value. When we have that fair market value established by the buyers and sellers themselves, and we get that neutral zone, the activity that we get after that and the level that that establishes gives us the underlying framework of true market structure. That alone is a huge advantage when you compare yourself to looking at master pattern framework, fair market value, to someone who is using a indicator, say a moving average is kind of the purest form of something that can be adjusted with settings. So everyone else is trying to adjust moving averages and other settings-based indicators to the price action of the day or of the week or of the month, depending on what time frames they trade on. They're making those tweaks and those adjustments to those indicators. And the problem is that knowing what we know about market cycles, those settings will eventually fail. But what we're dealing with master pattern methodology is static framework. Once a value point is confirmed, it's there forever. No one can undo it. And the fact that we know we had a neutral balance point of supply and demand, manipulated or not, that's a whole nother discussion. But we have had the market makers allow for a balanced contraction point, a fair market value. The resulting activity that happens after that and the defining point that it gives really becomes the edge in determining where market is heading off to. Is it settling on value? Does it want to trade above value? Does it want to trade below value? How is that value constructed within higher time frame trends? Those points are by far the most important thing that we get from studying market phases, because everything else happens around those points. Things like the expansion phase leaving. Well, you guys know, because you've been doing this a long time, that the expansion phase can take a lot of specific forms. It can have one leg. It could be a direct breakout expansion. It could have multiple legs. You get first expansion leg, second expansion leg. You can get a lot of expansion legs, sometimes up to 9, 10 expansion legs in extreme circumstances before you break out into the third phase. So there's a lot of characteristics that can happen, but it's all expansion. It's all going from swing high to swing low, going from pain threshold to pain threshold as it develops. So point is, the fair market value is where it all starts. So that's a huge thing that we get out of here. This is one of the only methodologies that you get that static, consistent framework. A good strategy is built off constants in the market, something that constantly you can count on. And it could be something very, very simple. Contraction is very simple at its core, and it's constant. It happens every day on every time frame over and over and over again. So something as simple as compressed price action can be a huge foundational building block alone, just that one thing, to creating a consistent strategy. Many strategies to create on top of that. We have our basic strategy, trading in trend, overvalued, undervalued. But that one constant that always happens in the market is, without that, we couldn't do the other stuff. That's where it all starts from. So I don't mean to drone on too much about that, but it's important because these basic concepts are really the power in this whole thing. So, all right, master pattern cycle and phases. So just going through the phases as they're defined. Phase 1 is contraction or fair market value. Contraction is identified as simultaneous lower highs and higher lows, a contracting of a price range. When contraction takes place, this represents a balance of supply and demand in an agreement of fair market value between buyers and sellers. Now, that is the basic explanation. As we get deeper into this, and as you learn more, this is a balance that the market makers are allowing. It may not be a true balance as if it's all retail traders transacting. Remember, the market maker is the one that mediates all the trades. They can either choose to just fairly, as best as possible, match up buyers and sellers. That's how we would have the fairest market, is if they just took their spread. That's it. The problem is they don't just take their spread. they also trade proprietary positions. There's the market making desk, and right next door is the prop trading desk. And these two guys talk. Okay? Market maker knows where all the liquidity is, present and future. They have insight into all that. Proprietary trading guys just want to know where the next big move is coming. So those two departments are able to massively help each other out. And it all goes to the same profit center. So that's really why we don't have truly fair markets, is because there's an incentive for the market makers to use their advanced information to proprietarily trade. So you're not going to get a fair market value a lot of times. We don't know for sure, but it's not going to be established by just general retail traders or people trading their own account agreeing on price. We may, all in this room, all of us want to buy the market. And if we were the entire market, then it should go up. If we all think it's going to go to a higher price, we should all be continually willing to buy. The problem is we could all want to buy in this room if we were the entire market, but if we have to deal through a market maker, that market maker could be selling to all of our positions and suppressing the price. They could be dumping supply into the market and not allowing us to control the market, so that they're manipulating supply and demand by being that control floodgate. So it's important. This is a little deeper topic, but it's an important way to view these balance points, is that they are manipulated balance points, but balance points nonetheless. That then brings up the thought that how are these points significant to the market maker? Because the market makers are now adjusting their book of business. If we all want to buy and they're selling to our demand, and they're holding the price in this contraction pattern, how does that affect their risk profile from this exact level? These are advanced concepts, but we're just going to plant that there. We'll talk about it more as we go. But now it becomes a different game that is played in the expansion phase, because now it's a balance point for their book of business as well. So, okay. This leads us into phase 2, which is the expansion phase. Number of different ways expansion can happen, but we're going to talk about the confirmed major expansion point, which is going to have a 1- and 2-leg expansion. Okay, first leg is going to come through the top of the box. Second leg is going to come through the bottom of the contraction point. That's when it's confirmed. This can also be reversed. You can have your first leg through the bottom and second leg through the top. But basically what it comes down to is we have the defined contraction area, and then we take out the high and the low of that box before we create another box. That's what creates a general classic expansion pattern, or the beginning of it. So expansion starts the moment price breaks out of contraction. The expansion phase is characterized by whipsaw-like action, pivoting back and forth above and below the contraction high and low points. A confirmed expansion must have at least 2 legs that have broken the high and low points of the preceding contraction range. So pretty much what I just explained. Again, this can go on to have 3, 4, 5, 6, 7, 8, 9, 10 legs of expansion before we go to the third phase. So keep that in mind. We're just looking for the market phases. We know we have contraction. The moment we leave that contraction box, we're looking for it to go to the expansion. We know that it's a confirmed multi-leg expansion when we get that first and second leg that takes out the high and low of the box. Then it goes into the phase that we're really all interested in, which is phase number 3, the trend. The trend is identified as the price movement between the previous contraction point and a new contraction point established at higher or lower prices. In this example, it's established at lower prices, and then we go into another contraction. So the meat in the middle that we're all after is that trend phase. That's really where the market's going to be the easiest to trade, and it's going to have the biggest movement. The problem, and the reason why most people lose money, is because number 1, they don't understand the market moves and phases, and number 2, it is mostly in contraction and expansion all the time. 90% of the movement, depending on the overall market environment, there's months and years that can make it be a little more or less. But as a general rule of thumb, you are going to be in the contraction and expansion phase more than you're in the trend phase. The trend phase is relatively quick. So the reason that people get messed up and lose money is because everyone expects a trending market. We all want a trending market because that's where there's the big money to be made. The problem is that it's mostly not happening, so you get beat up inside the contraction and expansion. So the way that we handle this, just to jump into the basic strategy for a brief moment, just quickly tie this in, is a directional bias. We know that the market's going to be in contraction and expansion most of the time, much more than trend. It's two-thirds of the market phases are whippy and essentially sideways. Some small range in contraction, and then we get into bigger range into expansion. The idea is to navigate these market environments is we apply them to a directional bias on a higher time frame. That's a real trick here. That's where we bring strategy to the market phases. Because whether we're in contraction or expansion, as long as we're hitting it in a directional bias above or below value, depending on the higher time frame flow of money, we have a much higher chance of getting ourselves in the money and taking a profit and finding the trend phase. Nobody knows when the trend phase is going to happen. That's one of the biggest questions I get asked on YouTube is, how do you know you're in the trend phase? You don't really know because it happens so fast and so suddenly, it just goes. What you can do is anticipate the trend phase based on the higher time frame flow of money, and you get positioned according to the current market framework, the current contraction and fair market value. You position yourselves on the expansion legs in anticipation of landing yourself in the trend phase. It's the best that we can do. Outside of that, you would be trying to breakout trade as the market pushes down. The problem is, if it's a multi-leg expansion, it continues to expand for multiple legs, then you could get beat up trading the breakout as opposed to trading the expansion leg counter trend in the higher time frame direction of money. That what I just said there in essentially the last few minutes is what we're trying to do here. That is the basic strategy applied to the master pattern market phases. It's understanding this and pairing it with a directional bias. Not necessarily knowing when the trend's going to happen, but positioning yourself so that when it does happen in the predicted direction based on the higher time frame, that you're already in. That's it. Everything else we're going to talk about throughout this course is ways to refine this and be a little more fancy around it. But this is everything that we're here to do, is figure this out and get better at it. So, all right. The master pattern identified using ATS. So here's the same thing, but actually using the software. We have our phase one contraction, which puts out our value or our center of gravity, we'll call it sometimes. Our phase two is the expansion coming out of that box. And then phase three is a trend. And then it goes back into phase 1, 2, and 3 again, as we can see there. So just to kind of reiterate a little bit about the market phases, one thing that you want to get, that you want to be very clear on as you're coming into this methodology, and I'm not necessarily talking to this group because I know you guys already know this, but for anyone that's watching these videos later on, is that as you get into this methodology, you're going to come, most of the times you're going to come from a perspective that things have to be in very strict patterns, meaning a contraction box has to, if it's more than 50 pips tall, it doesn't qualify. Or if a expansion lasts more than 2 days, then it's a trend phase. You can't put these types of things in exact criteria boxes. An expansion can be a few candles or it could be 20 candles. A contraction box can be 5 pips tall or 50 pips tall. What you have to understand is that the price action and the activity, no matter how big or how long it takes, is what it is. And you have to be flexible to that. That's where people start having a hard time, is they start to bring old school trader thinking, what everyone else is doing, and trying to put this methodology in an exact box. and the reason they do that is so that they could get exact stop loss levels. And how should I use a trailing stop? How big should that be? And what's the exact profit target? That is not the thinking that this methodology is based on. That thinking requires constant optimization to whatever the market's doing. This, you're looking at general market cycles. We are adapting to the cycle. That means that you'll be changing your risk management and your position sizing and things like that dependent on the size of the framework as it's playing out. The framework dictates how we show up, not our own beliefs and the criterias we're trying to force the market into. So that's a key thing to understand about master pattern methodology and market phases. The phase is the bottom line. And the size of that phase and the length of that phase is determined by the market. We're here to adapt, not to try to put it into a box that we can say these exact levels, these exact criterias are going to be how we approach it from here on out. You cannot do that with this. And if you're trying to do that, you're going to be very disappointed. So just want to make that clear. All right. So your number one enemy in trading is the desire to change. I'm firm on this. And I think this is super, super important. Let's just go through the lesson. The desire to change is changing indicators or systems, changing markets, changing timeframes. Change, change, change. Okay? You do not want to change anything. You want to specialize. To be great at anything, you have to specialize. Okay? Every time you change anything, you have to learn a new game, and you can think about it as this tennis court analogy I've been using lately. So let's kind of go through that real quick. If we think about this as playing the game of tennis, there are defined rules that keep it equal on both sides. And what you don't want to do on tennis, typically you don't want to miss the ball if they hit it. You want to be able to hit it back, but also too, you don't want to hit it out of bounds when it goes across the other side. So I'm going to be talking about it from that perspective of hitting the ball out of bounds. There's other factors here, but just try to take the analogy away from this in its basic form. It's not super complicated. So on Monday, you have a trading approach, a way that you've defined you're going to approach the market, okay? And let's say it's pretty even to your opponent. Your side is half the rectangle. Your opponent's side is the other half. You're both hanging above the net, okay? You're learning this game, okay? Come Tuesday, if you've changed your methodology, you've changed your time frames, changed your indicators, changed anything like that, you have made the game more difficult now because the progress you made on Monday does not quite fully apply to Tuesday. So it's likened to changing your opponent's side of the court. Now it's easier for you to hit the ball out of bounds, right? You're changing the structure of the court. Okay, now we go to Wednesday. If you change again, now the boundaries have changed again. And we could even add other things to this just so you guys fully get the analogy. It's not a perfect analogy, but changing your system could be changing the net height. On Tuesday, it was at standard height, and now it's a foot higher. You could still play, but the way you're swinging, the way you're adjusting your approach, you're changing the rules. And now you have to get accustomed to that new thing. So as you keep going, you notice the shapes change. And again, the analogy, what we're trying to get to get you guys to understand here is that every time you change, you are no longer specializing, and therefore you cannot build on the progress of the thing that you've been practicing. It's all about practice at the end of the day. And a lot of people feel that they need to change their approach because they don't want to miss opportunity. And it's the other way around. By changing your approach, you end up not being a specialist, and you're never good at any of the approaches. And so what ends up feeling like it'll go faster because you're trying to adapt your system to every single market environment and condition, what ends up feeling like it would go faster is much slower. And that's the counterintuitive thing that most people don't understand being traders. They don't understand that this is the case. Going slower and specializing in your the indicators you're using, the markets you trade, and the time frames you use to trade those markets is faster in the long run. And we have data to support this, especially now with the prop firm data. You can clearly see a difference between those that stay on one market with the same time frames. You can see how long they're typically in trades, and we can see a clear directional bias in the fact that their buys and sells are typically the same on a given day. And so you know that they're following a higher time frame trend. When you see these consistencies, the days to pass goes way down. The swings in equity go way down. It's very, very clear. When you see it all over the place, we see that there's been 10 markets that they've traded. You can see that they've had, there's buys and sells on the same day. Every once in a while you'll get that if you get a true reversal, especially if you're trading like a 5-minute into a 4-hour. There could be early in the session, you take one buy and then it rotates, sets up, and then you sell the rest of the day. That can happen, but as a general rule of thumb, typically there's a direction of the day and you stay in that direction most days. So if we see a bunch of buy, sell, buy, sell, buy, sell, buy, sell, 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 especially over trading, and it's all mixed, we know there's no directional bias. They're not following that best practice. So when we see those things and we see their trade hold time, one day they'll be in a trade 2 minutes, the next trade they're in for 2 days, and then they're in for an hour, and then they're in for 15 minutes, and they're in for 4 hours. There's no method. They're switching around their time frames. They're looking at a 5 into a 4 hour, but they're also looking at a 1 minute chart, just because I feel like if I look at that 1 minute, I could just get a little bit better entry. It's complicating things. You only need an entry time frame and a directional bias. Once you're good on that and you're solid, you can add a time frame in the middle. You can do things because now you're qualified to do that. But you're not doing yourself any favors, especially when you're new. You want to keep things very simple for decision making. So on the data, we can see what the change does, how it makes them take a much longer to pass the challenges and get funded, and their equity swings are much crazier. So specializing out of this lesson of the master pattern framework and how this all ties in is that the master pattern framework handles your indicators and systems part. It is the same every day on every time frame that you decide to trade. It never changes, ever. That gets rid of the change on that. You don't need to add indicators if you're using ATS methodology. Or you're using the software. If you're watching this, you don't need to add another indicator to your screen. If you feel like you're pressured to add another indicator, that's that old trader thinking. I'm not going to tell you what to do. It's your decision. But the cleaner you keep the screen, where you can see the raw price action and you can see ATS's enhancement to raw price action, so that's all it is. It's a minor enhancement to just traditional price action. The cleaner you keep things, the better you're going to do. The reason you don't want to keep it clean is because you're battling the old thinking that more is better. And it's that if you could overcome that early, you're going to go much, much faster in this. So just want to make that clear. The thing you're going to have to battle with, hopefully not very long, is changing markets and time frames, even with using ATS, because the framework handles the indicator part of the master pattern. But then there's what markets should I trade? Am I missing opportunity? Because now I have this great system, this great understanding. How many markets should I be looking at? Well, I think that you should look at one. The only way I would say add more is if you're trading, say, a 4-hour into a weekly, or a daily into a monthly. Then there's so much time that goes by between setups that maybe you could add 1 or 2 more pairs. But at the end of the day, if you execute really, really well on one pair, that's going to allow you to potentially raise your position sizing because you're going to be just really good. You're going to be able to be present for all the good opportunities in that pair. Whereas if you're jumping between pairs, you're going to be shooting at, you might get a good setup here and there, but you're going to be shooting at a bunch. You can never be great at one. It would better serve you if you were just lying in wait on one pair to go heavy at the best moment when things are in alignment, things are perfectly set up. It's very, very clear what you're looking at. That would serve you better than spreading yourself thin over a bunch of different pairs, because then you can never be great at any of them. What feels like a good setup in one, you get invested in that, you put your margin into that, and now you're looking at another pair, you're like, well, that setup looks a little better now. What do? Do you take that position off? Maybe that's still a good position, but now you like this one better. Some people that are real amateurs, they'll then close that one and they'll invest in this one. And then that one takes off, and then this one ends up not being that good. It's better to just be great at one pair and not change, so that you can show up ready to, totally prepared to maximize all opportunity in that pair. And if you're not trading, fine, you're protecting capital. Most people aren't. Most people are losing. So the fact that you are maybe sitting on your hands because things aren't clear in your pair is better than most people can say, because they may be having a lot of fun chasing opportunity, but their capital is most likely going that way. And so you don't want that to be the case for you. So, and then the last thing is changing time frames. You want to land on one set of time frames, because changing time frames is another way of just re-optimizing. Every time frame will have its day. Sometimes the lower time frames are going to perform really well. Sometimes the higher time frames are going to perform really well. You have to just live through it and go through the cycles and the phases on those time frames, so that, again, you could show up prepared to catch that expansion leg coming into that trend phase, and you can be prepared for that. If you're chasing time frames, it's just another way of re-optimizing, and then things could happen without you on the time frame you were at before because you switched. You don't want to be chasing things around. You just want to be strategically lying in wait for the opportunity and be ready to attack. All right, so I think I beat that horse enough. All right, so trading the master pattern demands that you stop changing and start specializing. I think I've pretty much cemented that in. So what's the takeaway of this lesson? Price is always in one of these three master pattern phases. Again, you could always define whether you're in contraction, expansion, and then the trend is a little bit more difficult. But we are really, the essence of what we're doing here is not to try to find the trend, it's to trade in anticipation of the trend. So we do that by expertly navigating contraction and expansion. You want to study contraction and expansion more than the trend, and how to effectively navigate those phases. When you understand the master pattern cycle, you can anticipate the phases, interact with them in a profitable, sustainable way. I just covered that. Your ability over time to identify each phase accurately will determine your overall win rate. And that combined also with your directional bias, which we'll talk more about that as we go through the different levels of the master pattern understanding. So that's pretty much what I have for the slides here. Do you guys have any questions? I know this group's pretty astute to these things, but any questions that you think someone as a beginner would have that I didn't cover in here, anything along those lines, and I could unmute you and raise your hand, or if you want to raise your hand. All right, you guys got it. You guys aren't feeding me any questions here. All right. Well, if there's no questions, there's no questions. I'm not going to invent them. So I think I covered it pretty thoroughly, and yeah, I don't think I can get much. I think I probably went a little too thorough on the very first level of master pattern, but that's okay. We'll keep digging through, and hopefully those of you guys that are watching this on the actual lesson have had your questions answered, and we'll move on to the next lesson.